Hello, my name is Gray. Today I want to talk about why gold must go down in a very straight manner, meaning it will be no wiggle waggle around and it will be one downtrend which will be very acute. So I will analyze from two perspectives. One is Elliot wave principle and the other is COT data, positioning data. Elliot wave principle is a little complicated in its practice and opinions differ from counting and some details, but I do believe in Elliot wave principle and I will show you a very concise analyze according to my perspective to Elliot wave principle. Basically, I will demonstrate very concise forms so that you will not waste so much time and grasp my ideas and why I think according to Elliot wave principle, gold must go down in a very acute manner. Let's start a little bit of introduction to Elliot wave principle. It will be very fast. I know most of you don't want to go in all details, so it will be very fast and concise. All right. We have 5 waves in one direction. All right. So this is called impulsive wave, and corrections are called corrections. So we have ABC as corrections and 1, 2, 3, 4, 5 as impulsive wave, which means it will go in a one direction without wiggle waggle. No. We have 5 wave and wave 2 and 4 are corrections. Alright? But we have also the law of fractality in the charts, meaning each of these corrections, each section of these corrections also have ABC in them. But there is a difference. The difference is the C wave has 1, 2, 3, 4, 5 in it. But this 1, 2, 3, 4, 5 also, like this 1, 2, 3, 4, 5 has corrections. And again, these corrections have corrections within them. Alright? So it's simple and complicated. While all of these have again 1, 2, 3, 4, 5 in them. Alright? And so corrections have ABC, but wave 1, wave 3, and wave 5 has 1, 2, 3, 4, 5. Alright. So let's get into the main job. Alright, here according to my calculations, this is A, the correction A, which again have ABC in it. This is B, and then we will have C. And again, this ABC is a gigantic A, and then we will have a B, and then we will have a C. Alright? So it is this simple. But why I do think like that, I have gone to smallest time frames and calculated according to the way I calculate Elliot wave principle, which is very accurate and a little personalized, and I really believe in it because it works. like a clock. So there is no reason why I should doubt it at this point, because I have calculated it very, very much. Most of the people may say this is ABC, all right? And then this whole ABC would be one gigantic A, and then B, and we will have a C, which again, we will have a big acute downtrend, and all of the stuff that I put here or here or here does not mean it will go to that price. I'm talking about only the structure of Elliot's wave principle. All right, and if I want to demonstrate a little bit more, I will tell that this is the correction of wave B. So this A, B, C is wave B. That's why this is the first ABC, and this is the main ABC. And so this is not that complicated for people who practice Elliott wave principle. According to my calculations, even though I will talk in this whole video why gold must go down so drastic, so rapidly for also other reason, yet I do believe that gold should hit 4,400 on GC ticker, not XAUUSD. So meaning here it didn't hit, so it must hit, and it might crazy, because I am talking about why this is the end, this is the top throughout whole this video. Why I'm saying because it didn't hit this level, it must go up and hit this level and then go back downward, and meaning basically wave B should be around here, higher than this, and then we will have the first C, and then we will have the second major B, and then we will have the major C. So, alright, I don't want to waste so much more time in this, and let's get into the next part, which also make me sure why it must go down so rapidly in a acute manner. So there is a data called COT data, commitment of traders data. It is popularized and almost got attention for the first time by Larry Williams, which is a very professional millionaire who made all of his money by trading. But I have learned it with Jason Shapiro, which is a market wizard. He has been audited in New Market Wizard's book. He has made millions of dollars just by COT data and news, and he has strategized his process with only these two. So let's get into what is COT data, and it's very simple, so I will get into it. And if you like, you can check out Jason Shapiro also, which he will talk about a lot on this subject, while his whole process is so simple. So I will demonstrate it, and it would be like 90 or 100% of his process. First of all, COT data is a data which comes out of CFTC. So what is CFTC? CFTC is a government agency will release these data almost every Friday, every week. By right now, we have government shutdown, so it hasn't been released for more than a month. But if it does not come out every week, it will come out every 2 weeks at most. So CFTC stands for Commodity Futures Trading Commission. And it doesn't matter what it stands for anyway. But this website is the source of COT data. Yet, they will release these data in Notepad form, in very text raw form, which is not appealing, a little bit hard to read. So there are other websites which you can check out to see it in a more graphical way. One of the websites which I do prefer is tradingstare.com. So as you can see, it says COT data reported are delayed due to US government shutdown, which means they get the money but they don't work. But anyway, right now, so I will show you how to get COT reports from tradingstare.com, but this is my website of choice. You can use any other websites like MyFX book is great and other websites. So you go to COT reports, you click on it, there is 3 sections. I use COT legacy futures, which is classic version, which is simplest version, which from my understanding, I don't need more data than it serves. You go and find the ticker which you want, which in this case, we go to metals and we hit gold. So as you can see, the last data is 23rd of the last month. We are right now at 28th October, and so there are 3 sections here. One is commercial, one is non-commercial, and one is non-reportable. Commercials are producers, meaning I am trader, I don't produce cattle or hog, or I don't have gold mine, I don't produce gold out of mine, right? So I am the trader, and they are the producers. The commercials are hedgers against our position, meaning if I trade futures, someone has to go against me in futures contract, right? If I want to trade like wheat in the futures, someone has to sell or buy in the futures against my position as a one who has physically that item. So we have non-commercial, meaning the big traders, the institutional traders, and we have non-reportable. It is called non-reportable because we are small traders and we don't have to trade. But if you would have a very big position, we have to report. So non-reportable are small traders, reportables or non-commercials or institutional traders or big gigantic position traders. I mean, big gigantic traders. So this is not sentiment. This is the actual positioning which they have at the time which this report have been released. All right. So the commercials, which is exactly the opposite side of both traders category combined, are 82% short, meaning the traders are 82% long overall. And we have 17% long in commercials, meaning overall the position of traders are 17% short. We have non-commercials, institutional traders, 83% long, and of course the opposite side to get to the 100% is 16, and we have non-reportables, which are 68% long. So here's the matter. If most traders are losers, you shouldn't be on their side if most traders are losers, let's say. According to the data, 96% of day traders are losers. So you shouldn't be on the side of the crowded market. You should not be on the side which is crowded, because that's the loser sides over time, not every time, but over time. While if most of the people are crowded on one side, let's say long positions, right? If they get out, it will go like, if they get out, because they are chunks of people, of positions on one side, when they get out, it will be a very, very gigantic dump, because it's a lot of positions which will be closed. And we know people are emotional, they don't do the rational thing, and they react to the candles, to the news, to the whatever goes against them, and they will follow their emotion and they will get out because it is crowded. It will get so drastic, which means if they all belong, when they close their position, it will drastically go down. Or if they all be short, if they close their short, it will go up consequently. But you will say, oh, so in this way, the institutional traders won't make money. So, how do institutional traders make money if most of them are long right now and they are supposed to get squeezed, right? First of all, the way that they will build their position is that they will start small and add to their position. So consequently, if they be 80%, let's say here, long, right? If it goes down, they are not in loss, they are still in profit. So because they have built their position over time from lower prices. The other matter is that they are not necessarily in profit, so there will be a chunk of institutional traders which will not be profitable. So that is also always the case. Let's build another perspective into COT data. Let's say everybody has bought an item, let's say this pen, right? So if everyone have bought this pen, why would anybody buy this more? Or if most of the institutional traders' money is long, why they would go more long, right? I mean, if most of their money is into it, there is not much more money to get into it. And also, it makes it more fragile, meaning if it goes down, because they have built their position so much big, when they go out, they will close it so much. They will close a big position, so it will go down so rapidly, so drastically. The other matter is that, like for example, Justin Shapiro's process is that he will look at the news. So if good news, make it lower prices, meaning if it be against the crowds, the news which supposed to be for them, good for them, be a bad in reality in the charts. It means that it is a strong news against them, because if it doesn't go up in the good news, so it is so much bad for that chart. So he will open his position on that news after the confirmation of this idea, meaning good news make a bad effect, and then he will make his stop loss at the utmost point, meaning if it goes higher, and he will get out soon. So if chart goes to the next section, he will be out and will not stay with the bad trade. So these are my ideas. I hope you liked this video. Please like and subscribe. And if you wanted me to teach you or coach you or analyze a chart or ask me anything, please contact me via email. Thank you.